Thanks for joining us today on Market Call. I'm Morella Fernandez. Chris Blumas on the show with us today. He's portfolio manager at Raymond James Investment Counsel. He'll take your questions on North American large caps. Here's how to reach us. Call us toll free at 1-855-326-6266. You can email your questions in today as well. Market Call at bnnbloomberg.ca. Chris, good to see you.
Hi, Morella. Thanks for having me.
U.S. job numbers came out. They're stronger than expected. Does this reduce any expectation, you think, of rate cuts from the U.S. Fed this year?
Absolutely. I mean, the numbers came out this morning, like you said, they were very, very strong. And I think what you saw in the futures market, it reacted accordingly. I think they're still pricing in that there'll be, rate cuts, in 2026, but it's pushed them out a couple months.
Okay. Let's talk about the U.S. government spending this year. You see that as a very big driver of GDP.
It is. And when you see like the strong employment numbers out of the U.S. and you hear what's going on around the world, there's a lot of focus on kind of, AI spending and things like that. And I think AI spending has been quite a big stimulus. But if you look at government spending, and this is government spending in the U.S., in Canada, in most developed countries, the spending is massive. And I think this, combined with the spending on AI and data centers is a big catalyst driving economies.
Okay, what else do you see driving markets this year?
Well, I mean, markets in general, it's kind of on a case-by-case and sector-by-sector basis. At some points, you'll see some sectors that are very strong, and other times there are other sectors that aren't. I think when you look at it overall, Canada has fundamentally different drivers than the U.S. Just with U.S., the market is largely, more than a third of the market is kind of tech-focused, and that's really what's driven it over time. Canada, we're more resource-focused, and if you look at last year, it was really gold. Gold had really, very, very strong driver of the Canadian markets. But the correlation between those two things is different.
Okay. And do you see gold continuing to push higher, meaning the markets in Canada move higher?
That's a tough call. Gold has had a really, really big move last year. And the main driver of gold has been central bank buying, and that, central banks have increased their buying of gold over the last few years, and gold has become, the largest reserve currency. So I think what you saw with the appointment of the new Fed chairman is people were really worried about a lot of the uncertainty in the U.S., and that was really driving gold, and you really saw it come off with the announcement of the incoming Fed chairman. So I think people have taken that as a positive, and that could be, a catalyst that really doesn't drive gold anymore.
Okay, let's take a quick break. We will line up the first phone calls for Chris Blumas, Raymond James Investment Counsel. He'll take your question today on North American large caps. Here is how to reach us, both phone number and email. Back in a moment. Welcome back. Let's go to an email from Robin. He has a question for Chris. He says, good afternoon. Could Chris comment on MSFT, Microsoft? It's fallen back a little bit lately. Chris, we know it fell back after earnings and concerns over software. So what do you think?
Yeah, so, this is one that I do like a lot. And I think really what caught people off guard, on their most recently release, the numbers were quite strong. The cash flows were quite strong. I think what, gave people pause and led to the sell-off, it was really the CapEx spend, right? That's something that kind of, I would say, caught market participants a little bit off guard. And this is kind of goes with the trend of these larger cap companies, really, really focused on AI and securing kind of a future there. And really these large companies that have massive cash flow willing to spend. And so I think, in my mind, it was a little bit of an overreaction. This is a very well-run company, wonderful business economics, a great balance sheet. And I think it's positioning itself for the future. So I think, this is one where you would want to buy on a pullback. So I think, very much like it. And I think the valuation is attractive.
Okay. That was a question from Robin. Let's go to our first caller today. Chris on the line in Delta, BC. Hi, Chris.
Oh, hi, Morella. Hi, Chris. Chris, I'd love to ask you about Brookfield Asset Management and the Brookfields in general. I'm a 30-year-old investor, long 10-plus year time horizon, and I'm able to lock in for that time horizon. And I'm wondering which of the Brookfields, if there is one, would be the most appropriate for my sort of situation. Thank you so much.
Okay, for a longer term hold, Chris, what do you think?
Yeah, this is a wonderful question. And I think, in terms of my preference, Brookfield is a big conglomerate. And so at the top of the conglomerate is Brookfield Corp. And underneath it, you have a number of its operating subsidiaries. And the operating subsidiaries are more income focused because what they do is they pay their dividends up to the holding company, which is Brookfield Corp. So I think for somebody who isn't income focused and is growth focused, you want to be at the top of the pyramid. So you want to own Brookfield Corp. And what that allows you to do is within Brookfield Corp, they're always going to be optimizing kind of the value for shareholders, because if one of their subsidiaries is trading at a rich multiple, they can issue shares. If one of their subsidiaries is trading at a very low multiple, they can buy back shares, they can privatize it. And so, you get some added levers of value creation at the top of the pyramid. And I think in terms of a longer term compounder, Brookfield Corp is as good of a long-term compounder as there is. So I think my preference would be for somebody younger who isn't income focused would be at the top of that pyramid and to buy right and just let it work for you.
Okay, that was good advice. Let's go to Doug in Orangeville, Ontario with his question. Hi, Doug.
Hi there. Good afternoon, Morella and Chris. If I would call in today about a question many people would have, and that's regarding Allied Property REIT. I've known the REIT for many years and some great properties. I'm wondering if you see today's action as an opportunity to get in. Thank you very much.
Okay,
Bye.
thank you for the question. Allied REIT down by quite a bit today after reporting some earnings. Can I get how you feel about Allied and whether you'd pick it up now? And then your thoughts, Chris, more widely on the space?
Absolutely. And then maybe I'll start first with just the space and the structure. In terms of a REIT, it's a flawed structure. It really is, because what a REIT does is pays out the majority of its income to avoid taxation. And what that does is when there's a market downturn or a downturn in the economy, it leaves them vulnerable to a capital raise. And this is exactly what you saw today is, Allied announced a big write-down of their office properties, and they also announced a big capital raise, which is going to dilute existing shareholders. So even if you are very, very positive on the future of Allied, and the earnings outlook longer term, you're going to have more shareholders. So just that added dilution will bring earnings down. So I think, unless you need the income, I wouldn't consider investing in a REIT. There's other, the two real estate kind of companies that I own in client portfolios is Boardwalk, which has a very, very low payout, and that risk of dilution is very low, and Mainstreet Equity, which is a corp and doesn't pay out. If you're not able to do counter-cyclical acquisitions in a more cyclical industry like real estate, your value added is significantly lower. So I would look for REITs that have below average payouts that really can operate in a counter-cyclical way. And I think what Allied showed you today is they just can't. And yes, their earnings can bounce back, but you're going to have significantly more shareholders that are claiming those earnings in the future. And so the upside on those shares is limited.
Okay. Allied Properties, by the way, down about 27% right now. Let's go to an email from David in Bridgewater, Nova Scotia. He says, could I get your opinion of Walmart as a buy at the current price? We'll pull up the Walmart line chart in just a moment. Walmart's done pretty well with incorporating AI. Chris, it's currently at 128. Do you like it here?
I don't. I think this is a wonderful business. Absolutely, creates a lot of value for its customers. And if you look at, three that I believe add a lot of value for customers, you look at Walmart, you look at Costco, and you look at Dollarama. I just struggle with the valuations. In the end, to get a good longer-term return, you need earnings growth and you need some type of multiple expansions. And if you look at the valuation of Walmart today, it's the three that I mentioned, they're a very, very defensive haven for investors, and that's really bid up the shares. And so I can't come to grips investing in these types of businesses, given their growth profiles at those valuations, but I would wholeheartedly, consider investing in them, if the share prices were to pull back a bit.
Okay, and how much of a pullback would you look for?
It would be significant. The three that I mentioned, their price to earnings ratios are all north of 40%. And so I think, 40 times earnings. I mean, that's a very, very rich valuation. And even if the growth were to just moderate slightly, and that multiple goes down in some cases from 50 to 40 or 40 to 35, your total return is going to be very, very flat. So I think you don't want to chase returns here. I think you want to be patient, and I think you'd need a significant pullback.
Okay. All right, let's leave it here right now. We're going to line up some more phone calls for Chris Blumas, Raymond James Investment Counsel. Again, he's taking your questions on North American large caps. We're back in just a moment. Welcome back to Market Call. Chris is with us to take more questions. We are going to an email from Sally. She says, could you ask your guest if POW is right to buy at this level? This is Power Core, and we will pull it up on the line chart in just a moment. Can you tell us what you think of Power Core? It is quite a bit down.
It is, and this is a very, very well-run company, with a long-term focus. And really what you get with an investment in Power Corp is, the major asset is Great-West Life. And, the top two assets are Great-West Life and IGM Financial. The third asset you get is you get, some fintech investments and some of their alternative investments. This is less than 5% of kind of the total assets. So it's a very, very small percentage. So in essence, this is a financial conglomerate. And my preference here would be to look at something, I don't own this one, but I do own Great-West Life. And, the argument for getting access to the fintech and the alternative assets is, you can go out into the market and you can buy, a Brookfield Asset Management, a KKR, an Apollo. You can buy more of a pure play alternative asset manager. And so my preference here in terms of Power, the price to earnings ratio is right around 13.5 times. That's a little bit rich for this type of business. Historically, it's traded at around 11 times. So I think from a valuation perspective, it's quite rich, but it does have a very nice dividend right around, the high 3.5%. But I think instead, I would look more at Great-West Life. You get a little bit lower of a multiple and a little bit higher of a dividend yield. And you still get a very, very, reasonable growth. So I think that would be my preference, Great-West Life over Power Corp.
Okay. Let's move on then to Ted in Hamilton, Ontario. He's got a question. Hi, Ted.
Hi. My question is about Intact Insurance. They reported what I thought was good results yesterday, increased their dividend, but yet they're taking it on the chin today. They're down about 4 or 5%. We have Fairfax and Definity reporting tomorrow, and they're down as well by a similar percentage. I was just wondering, you comment on what's going on in that area?
Okay, thank you for the question. Can you talk to specifically Intact to start?
No, absolutely. In terms of Intact, the market reaction was likely a market reaction. I don't know it's always a company-specific reaction. Like you said, your caller alluded to, the numbers were quite robust. I think what people are kind of thinking at when they look forward is that the market is expected to be a little bit soft. There's a lot of reinsurance capital, in the marketplace, and there's a lot of insurance capital in the marketplace, and that tends to be very good for consumers and leads to a little bit more price competition and lower profitability for the insurers. That said, like Intact's, very, very well run. It generates more than half of its premiums from the Canadian marketplace. So, it is a little bit more defensive in that way, and I think the valuation is quite reasonable. If you combine this, compare this to Fairfax. Fairfax is a different beast. It has different regional exposures, but I think with Intact, valuation is very, very attractive. So if this is one that your caller has their heart set on, I think, it would be an attractive entry price.
Okay. Let's go back to the phone lines then. Trevor's on the line. He's in Arizona with a question. Hi, Trevor.
Well, hi. And my question today is on Visa. They make money from credit card transactions. Now, regarding their moat, how vulnerable are they against something like a stable coin or Bitcoin, as well as artificial intelligence? Thank you.
Okay, thank you for the question. We've talked a little bit about this in the past, whether or not that business model from the Visa, from the MasterCard is threatened by digital payments or something else.
Yeah, and I mean, to be honest, like Visa and MasterCard are payment networks, so they are the networks for digital payments. And so, Visa is the largest digital payment network in the world, and that's essentially what allows it to be the most profitable. So, Visa is one that I do like. I do own it in client portfolios. I think the valuation is quite reasonable. And, over time, as more and more transactions have gone, digital, Visa's been a primary beneficiary, and I would expect this to continue. In terms of kind of competition from artificial intelligence, Visa is likely going to be, and they already are, they've alluded to it, they're incorporating artificial intelligence across their platform, to make security more robust or detect fraud. So I think, absolutely they'll be using it, which most large companies will be. And in terms of kind of competition from stable coins, what's really hard to get a competitive, to really compete with a payment network is the way Visa and MasterCard were created. It was kind of a conglomerate of many companies when they started kind of banding together to use them. And so the thing is, those networks are very, very difficult, and they may be, impossible to replicate. And so, as they've grown, that's essentially what their moat is, it's very, very difficult to create a payment network these days because you couldn't get all the counterparties to agree. So I think that's what allows Visa's moat to endure, and I would expect this to continue. On the flip side, I would expect, there's going to be some headline, like there always is with anti-competitive, penalties that they pay, but that seems to be just kind of part of the business model, and they pay the penalties and business goes on.
Is there any obvious challenger at this point to either of those companies, Visa or MasterCard?
I mean, there's no obvious challengers in terms of the scales of the payment networks. If not that I know of.
Okay. All right, let's go to Reg. Reg is on the line. He's in Winnipeg today. Hi, Reg.
Hi, thanks for taking my call. So my question to Chris today is on Manulife Financial. Now, Chris, Manulife Financial will report their earnings at the end of the day today. I think they're going to beat the analysts' expectations. Let's assume that I'm right, and they do beat the analysts' expectations today. The shorts and the day traders will obviously try and push the stock down, which seems to be the pattern with Manulife. It should be much higher than where it's currently trading at. But assuming that they beat the analysts' expectations, they're the only insurer that has a bank that competes against the banks that actually own a large chunk of the Manulife shares. This stock should easily be over $60, and it's for some reason it kind of flatlines. Where do you see this going? I think it's, when you line it up with the other insurers, and it's got a far better reach as far as diversification versus the other insurers. I like your opinion. Thank you.
Okay, thank you for that question, Reg. Chris, what do you think?
Yeah, I mean, in terms of the life insurance sector in general, why the multiples are, even if you compared the life insurers versus the banks, okay, if you look at the Canadian banks, you're 13 to 15 times on a PE, and if you look at the insurers, you're 11 to 13. So they trade at a significant discount. So why do they trade at that discount? It really has to do with growth. Insurance is a mature market. If you look at how they're trying to grow their business, they're going into different markets. So Manulife is going into it has a more Asian-centric business. When you go into Asia, you can't do things on your own. So you need to partner with kind of a local company. And, they have to do lots of joint ventures. The profitability on a joint venture is a lot different than the profitability on kind of 100% controlled subsidiary. So I think in terms of its valuation, Manulife, it really has to do with the growth outlook. And because, they pay out a significant portion of their earnings and dividends, it's more of an income stock in my mind versus a growth stock. So if you're looking for income, I think it's an attractive income stock. I still think the valuation is fair to me. I just don't think this is a business that deserves a 15 times PE, just given the interest rate risk that you take with an insurance company. So I think, it's right around fair value. If you're looking for income, I think, you couldn't go wrong with Manulife or Great-West Life. So kind of that's my take on the space.
Okay, let's leave it there for now. We're going to take a quick break. When we come back, a look at Chris's past picks. That's coming up next. Welcome back. Time to take a look at Chris's past picks from February 12th, 2025, so almost exactly a year ago. At the time, Chris, you chose Honeywell, HON, on the NASDAQ at 205.01 US, now to 243.21, so 26% upside and total return of 28%. Have you held on to Honeywell?
I have. And I think, the thesis on Honeywell is really this is a company that is deconsolidating. So it's breaking up. And I think one of the things that the return doesn't capture is, their materials business was spun off, and you would receive shares of that as well. So that would actually have boosted the total return by 10 additional %. And I think that's really the thesis, is that the sum of the parts are worth significantly more than the Honeywell conglomerate was. And so still like it, and I still hold the shares of Honeywell and its materials business.
Okay, let's get to your next past pick, which was Couche-Tard, very well-known sort of convenience store company, went after something in Japan, and that ended up not working out, the 7-Eleven deal. But they made a recent announcement about sort of putting M&A on hold, and that has really sent the stock up. So you had it at 72.58 a year ago. It's up to 81.76 today, 13% upside, 14 total return. Was this an unexpected announcement that it's going to sort of stop M&A for a little bit?
It wasn't, because today was their investor day. And so, what they announced is kind of their longer term plans. I think, some of their M&A attempts or inquiries in the past kind of spooked people just because of the size of them. In the end, they, like I mentioned, they had their investor day today, and I think they announced, longer term earnings per share growth of 10+% out until 2030. So that's been a real positive. And the fact that they can do it without doing these big deals maybe gives people a little bit, more calm.
Okay, is this something you've held on to as well?
Absolutely, yeah.
Okay.
I still own it and would buy it today.
Okay, let's get to your third pick, TD Bank. Which is TD on the TSX, 85.57 a year ago to 134.24 today, 57% upside, 62% total return. You picked it up early last year, which was relatively, well, you might have picked it up before that, I'm not sure, but it was relatively pushed down by what had happened in the U.S.
Yeah, absolutely. And I think this is a really unique thing that can happen. With banks, it's just sentiment, right? Sentiment, and so many people who are index focused, they batter a stock down. And, what you had was a bank with a really good capital position and really good underlying earnings and a really depressed multiple. It was below 10 times earnings. And you look at where the multiple's gone to now, which is around 15 times. That multiple expansion has really driven that total return. Okay,
so let me ask you, do you think there's room for this bank to keep growing, or are you trimming at the time? How do you feel about the forward look for TD?
I think the multiple is too rich for me right now, so I wouldn't be buying it for new clients. And I have trimmed, just to kind of maintain the weight in the portfolio, but I am kind of constructive longer term about the earnings growth. And really, TD is an income-focused name. It's very rarely that you can get a total return like that in an income-focused name, and I think that's why you sometimes want to focus on, companies where you can get something on earnings growth and you can get something on multiple, because that can lead to a really, really robust return. I think the return going forward, is not as strong, but it's a very well-run company, and it's something that I would continue to hold for client portfolios. The
cap on the U.S. assets, is that going to hinder it, though, long term?
It's going to hinder it growing in the U.S., but, the growth in...
Okay.
For me, that's a positive.
Okay, we missed just a little bit of what you said, but we did catch it in the end. Let's take a quick break. We will be back with more of your phone calls for Chris in just a moment. Welcome back. Let's go to Kevin on the line. He has a question today for Chris. Kevin's in Toronto. Hi, Kevin.
Hi there. My question's on Shopify. It had a big tumble today, and I'm wondering if you'll be getting in at this price now that it's pulled back, or do you still see it as too expensive? Thank you.
Okay, thank you for the question. Shopify had revenue, Chris, that was up 31%, coming in at, $3.7 billion, but a missed on adjusted earnings. Is that what is taking the stock down today?
It is, and I think it's also what your caller alluded to is valuation. This is a business that trades right around 1x, it has a free cash flow yield of around 1%. So, it's a very, very rich multiple on Shopify, and it's a multiple that almost no other large cap tech name has. So while the growth was very, very good, it takes a lot to live up to that valuation. So I think, it is a business that I do like, but it's a valuation that I don't. So this is one I would stay away from.
Even where it is today?
Yeah.
Okay. Let's go to Sal. Sal's in Vancouver. He's got a question. Hi, Sal.
Hi there. Yeah, my question's on Main Street equity. I know that this has been a previous favorite of yours, and I'm just wondering, with the recent downtrend, is there any structural weakness here that would be good to know, or is this just the market just doing its normal, weighing machine type stuff? Thanks so much.
You referred to Main Street earlier, but can you give us a better idea here of what's going on?
Yeah, so Main Street is a corp, so they don't pay out any of the cash flow they generate. They keep it, and they focus on doing counter-cyclical acquisitions. And their regional footprint is more Western Canada, so they're big in Alberta, they're big in BC, and they're kind of growing in Saskatchewan. And so what they do is they kind of target, mid-market kind of multifamily rentals. And so these are, just say roughly 50 to 50 unit buildings. They're too small for a traditional REIT because it's not impactful enough, and they're also too large for the individual mom and pop operators. And so they're really in a very, very unique value-added sweet spot where they can acquire. They're vertically integrated, and so what they do is they tend to buy these assets very, very inexpensively. They rehab them, they refinance them, and then they kind of keep going. And I think what you've seen is they just reported results yesterday, very, very strong results, very strong growth, and again, taking advantage of the market opportunity. They've, increased the capital they have set aside for acquisition. So I think this is one that's, it operates in a sweet spot. The valuation is very, very attractive, and they're going on the offensive now. So this is one that I would buy today.
Okay. That was for Sal. Let's go to Danny in Montreal. Hi, Danny.
Hi, Chris. Hi, Morella. Love the show. My question is on Google, Alphabet. Any insights on why it's taking a bit of a beating? Used to be a bit of a safe haven compared to the others in the Mag 7s, but now, not so sure. Thanks.
Okay, thank you for that question. We were talking about Alphabet yesterday and the sale of these bonds that are 100-year bonds. First of all, do you see obvious reasons why it's taking a hit? I know a lot of the tech has not really come back to full, but any specific reason?
I think the primary reason would be valuation. This is a business that I love this company. I've owned it for a long time. I've recommended it, many times in the past. But what happened earlier this year is the multiple re-rated. This was a business that was, it had some antitrust overhang. It had some overhang on AI. It had some maybe inefficiencies related to its other subsidiaries. But there was massive, massive hidden value. And all of a sudden, when the multiple re-rated and the market realized that they weren't behind on AI, that they might actually be the leader, the multiple re-rated. So this is a business that went from 20 times to 30 times. And so any little bit of pullback, I would just kind of attribute it to just the valuation. I think it's a phenomenal longer-term compounder. I just think the valuation is a bit rich right now.
Okay. Let's get to an email then from George. He says, does your guest have an opinion on purchasing Meta? What do you think about Meta? They are obviously benefiting already from the use of AI because their ads are getting through. Their curated ads are definitely making them a profit. Is this a company you would invest in?
It is a company that I like. I haven't invested in Meta just because, my preference in the space is Google. And they both heavily target like the digital advertising market. So, within client portfolios, there's just not room for two. And so, my preference in the space is Google, but I don't have any issues with Meta. I think it's a very unique platform. It definitely generates a lot of value, and it has such a massive, massive user base that they've been able to monetize quite well. So I do like it. It's just I like Google more.
Got it. All right, let's take a quick break. Chris Blumas with us from Raymond James Investment Counsel, taking your questions on North American large caps. Back in a moment. Welcome back. Let's go to an email from Paul. He says, do you like Amazon for a long-term hold? We will turn that over to Chris. Amazon off a little bit on the day and did recently report earnings. I know you like Google. How do you feel about Amazon?
Slightly different story for me. I think in terms of there are some things that I really do like. The cloud services business, its AWS business is just a phenomenal business. With their structure, they own a lot of different businesses. And the things that people think about Amazon is really not the AWS. It's more the online platform. And, that is significantly less profitable. So for me, the AWS business I like. Some of the other businesses I like less. And so this is one that I don't own. In the end, there's a lot of unique technology companies, but you can't own them all. So I think this is one that I have no problems with, but I just think there's better opportunities elsewhere.
Okay, just going to follow up and ask, because we've been asked a lot of the big Mag 7 questions today. Besides Google, if you were to invest in one other, which one would it be?
Well, the ones that I do own in client portfolios, of the Mag 7 is Google and Microsoft. And I think, for various reasons, but, their cloud services businesses are quite strong. But then there are other, in Microsoft's case, its software business and productivity suites are quite attractive. And in terms of Google, its online advertising business is phenomenal. So I think, those packages for me, they generate more cash flow. And, if you look at kind of the valuations, the free cash flow yields are quite strong. So those are ones that I prefer.
Okay. Let's go to our next email then. This is from Sheila. She says, good afternoon, Chris. NA, so National Bank stock price continues to accelerate. Do you anticipate further upside along with a dividend increase? Appreciate your insight. So this is a question on National Bank, Chris.
Yeah, and I think I'll get the first thing right after that. I do see like a dividend increase coming. You don't know which quarter it's going to be, but their business has grown significantly with the acquisitions they've added over the last couple of years, and they typically target a certain payout ratio. So with earnings going up, the payout will go up over time. I think in terms of they were in a really unique spot, where you really the big five Canadian banks a little bit handcuffed and not able to do as much because of their size. They were able to kind of still do acquisitions. And that's really been what's led, they've been kind of peer leading growth over the last few years, which has been great. And then they've probably been, it depends on what time frame. If you go 3 or 5 years, they've been peer leading total return. And that has to do a lot with that there were deals that they could still do that other companies couldn't. So it is a name that I do like. I mean, I'll echo the same thing as with TD and with Royal it's just the valuation. I just think the valuation is a bit rich. But I would expect, the dividend to go up. But it's hard, to always assume that the growth will keep going as it has in the past, because as they get bigger, there's less they can do.
Okay. Let's go to caller Eric on the line in Montreal. Hi, Eric.
Hi.
Go ahead.
Talking about opportunity, here is Celestica. I want to know, if it's a good entry point right now because it's going down.
Okay, thank you for the question. Celestica here at $3.90 today. Do you like Celestica? Is it something you've invested in?
I do like it. It's not one that I've ever invested in. This is a business that did kind of a radical transformation a few years ago. When I kind of looked at kind of the semiconductor and kind of the accessory space, my go-to name in the space is Taiwan Semiconductor, because, regardless of, the chip architecture, the more advanced chips are only made by a few people. And so regardless of who's making them and who's designing them, in my mind, it all flows through Taiwan Semiconductor. So that's the one that I strategically liked, and that's the one I've invested in. Its multiple is, it's very, very rich. This is a business that we were able to buy in the past at 15 times earnings because it has some geopolitical risk given its location. That's not the case now. This is 30 times earnings. It has phenomenal growth. And so that's my preference in the space. Celestica kind of still feeds into a similar theme because the parts that it supplies are kind of peripheral parts that are right in the wheelhouse and support data center growth. The thing is, I find difficult to know how long that will last. And that's why I really just preferred strategically Taiwan versus Celestica. But I don't have any issues with Celestica other than valuation, which I have for Taiwan as well.
Okay. Let's go to another email then from Omar. He says, hi, Chris. Would you bet on Nike or Lululemon? Nike, of course, in the middle of a turnaround. Lululemon sort of in the first steps of that as well. Would you go either way with one of these companies?
I wouldn't. I had mentioned in the past about Nike, and I had initially bought it as part of a turnaround story. That turnaround story really wasn't playing out, and so that's a name that I exited. If you compare, like in both of these cases, they're retail turnarounds, very, very strong brands. But you see logistically, like how hard it is to turn around a brand, and a supply chain. And if you preface this to what we saw last year with TD Bank, when a bank operationally that didn't have a problem but was just going to reflect a one-time charge through its P&L, it's so much easier for some businesses to bounce back from certain charges. And I think in the retail space, it's very, very difficult to repurpose yourself or change supply chains and things that you've built out over years. These types of turnarounds take significantly longer and they have more risk. And so in Nike's case, I think even with growing anti-American sentiment, I think it's going to be hard for Nike to turn things around. I think with Lululemon, it could essentially at some point be a takeout target by private equity or a takeout target by another retailer. But I'm not convinced enough in its underlying operating fundamentals. I think that would be a nice benefit, but you have to buy it for its earnings and cash flow, which still are declining.
All right. Chris, we're going to leave the phone calls, the emails there, but when we come back, Chris has some new top picks he'll share. Back in a moment. Join us tomorrow for Market Calls. Stan Wong will be with us on the show, portfolio manager at Scotia Wealth Management. He'll take your questions on North American large caps and ETFs. That's tomorrow. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for new top picks from Chris. We're going to start with Thomson Reuters, TRI, on the TSX, badly beaten down recently by all the concerns about software. and you like it where it is right now, which is 119. Why do you like it? Why do the software AI concerns not bother you?
I think, the huge differentiator that Thomson Reuters has, their products service three kind of end markets, lawyers, compliance professionals, and accountants. And if you look at kind of their core product offerings, all of the information within their platforms is proprietary. And then if you look at that proprietary data and you look at, their staff, they have more than 3,000 legal and accounting professionals that work kind of curating this information. And so really the competitive advantage by having those two things is so difficult for it to replicate. And I think, the initial, with Anthropic, announcing that it's going to, it has some legal tools in its product suite, it's just very, very difficult to compete with Thomson Reuters because of the proprietary data and because of its, employees. So I think this is one that, could be a little bit more misunderstood. And, this is a company that for the last few years has been incorporating AI into its products. So I think, they could potentially even, they're likely to maintain their moat and they could even deepen it further. So this is one that I do like. And I think the valuation is a valuation that I've never seen on this stock in my life. So I think it's very, very attractive.
Okay, let's get to your next pick. And I should add, there's a theme that runs through all of your top picks today, which the viewers will see. Descartes Systems, DSG, on the TSX. They do sort of logistics and supply management software, primarily, I guess, in the U.S. What do you like about Descartes?
Yeah, and I guess the first thing, too, they are all, there's been so much negative sentiment around software, and there's been very little differentiation among, the competitive advantages of different software companies. So what you'll see is all three of these ones that I mentioned today that are our top picks are almost down the exact same amount. Very little differentiation for what they do and how they do it. And Descartes gets lumped in there as if it's an enterprise software company, but they're essentially operate a logistics network. And, that's a network that's been built up over, the last 20 years. And it's very, very difficult to replicate this network because, like any network, you need the participants and you need the data. And, their CEO was very, very clear, like there hasn't been another logistics network like this created in 20 years. And so, very, very costly to replicate. And given what they charge and the cost to replicate it, it would be uneconomic to even try to do it. So I think this is one that, again, is a little bit misunderstood, has a very, very deep moat. And it is a company, that is incorporating AI to kind of automate certain things because with supply chain and logistics, just with all the trade barriers, things have gotten more complex. So the demand for their products have grown, significantly.
Okay, let's get to your next pick, which is along the same lines, but in a sort of different outlook. Constellation Software, CSU, which again has been eaten up by concerns, and not only of AI taking away the business model, but also a change in leadership, I guess, as well. So what do you like about Constellation? Because if this is a company that buys other software companies to integrate them, do you feel like it's at the same threat of AI as the others?
I don't, but I think it's in a different way where, Thomson Reuters, it was really, their data and people. For Descartes, it's really their network. And for Constellation, it's really the size. This is a company that is a large cap company, but this is a company that's done over 1,000 acquisitions, since its IPO roughly 20 years ago. The majority of the companies and the software they provide is very, very small. And so if you look at, the $2 trillion that's been spent, in CapEx spending, by the hyperscalers, these aren't markets they're going to go after. These are very, very small niche markets that, where the client has very, very little incentive to switch to a competing product, and the economic rationale for creating a competing product is non-existent. So I think the best defense for Constellation is really it's an aggregator of 1,000, very, very small software companies. So, it has massive end market product diversity and it has massive client diversity. So, what thing they've alluded to is that now as some companies grow and maybe transition to more specialized platforms, they can actually incorporate AI to further customize and add features to their products. So, they are likely going to be a beneficiary as well. And I think with all of them, they have a differentiated way of why they have a competitive advantage, but they're all down the same amount, and the valuations are very, very compelling. And, when I talked about Shopify and the free cash flow yield, all of these businesses have a free cash flow yield, between 4 and 5%. So very, very attractive valuations.
Got it.
Within the space.
Chris, got to leave it there, so we're out of time. Thank you for your time, and thank you for joining us today on Market Call. We'll see you back here tomorrow.